So how can we make these policies consistent? Well, one approach is taken by the conventional view. In that view, policy is Ricardian. So the tax cut today creates an expectation that taxes are going to go up in the future. And how much will they go up? They'll go up so that the present value of the change in taxes exactly equals the current value of the tax cut. And then what happens is the present value of surpluses goes up because you're expecting higher taxes. That then is going to raise the value of government bonds. People are going to want to buy more bonds at any given price level. That's going to pivot the demand for bonds. And what will happen in this Ricardian world is that they are going to be willing to absorb the extra bonds without there being any change in the price level. And that's what's depicted here. So we have that taxes, expected taxes in the future are going up. That then raises this present value. And that means that at any given price level, people now want to hold more bonds. And because of the nature of the Ricardian experiment, where the change in bonds is going to be exactly equal, this is the change in nominal bonds, is exactly equal to the change in the present value of future surpluses. That means that P remains fixed. So mechanically what's going on in the bond market is the supply of bonds is shifting out, but the demand for bonds is also increasing, and it increases by exactly the amount of the shift out in supply, so that there ends up being no change in the price level. So this is one way that what happens in the bond market when you get a tax cut can be made consistent with what's happening in the money market. But that's not the only way that this can be made consistent. So let's turn to the alternative view. Well, in the alternative view, if the price level were to rise, as it does in this picture, so it rises from P1 to PA2, then we know that that's going to increase the nominal demand for money. Now, if the central bank keeps the money supply unchanged, then the only way that you can get equilibrium in the money market is if the nominal interest rate rises. Why is this? Well, think this through with me. If the price level rises, then the nominal demand for money goes up. So we have an excess demand for money. If the supply doesn't rise to satisfy that excess demand, then something has to happen to reduce demand. And the thing that will happen is the nominal rate will rise in order to squeeze out that excess demand. But here's the problem. If the nominal interest rate goes up, then debt service, that is interest on the debt, is going to go up, right? Government has to pay higher interest rate on the bonds that they sell, and that's going to mean that they are going to have to pay more in interest. So, but here's the problem, that we don't have any, if there's no change, if this present value of future surpluses is zero, then how are you going to finance that extra interest on the debt? Well, one way is you try to sell even more debt, right? And that process continues, and what's going to end up happening is debt explodes. This can't happen. There can't be an equilibrium where debt explodes, because nobody's going to borrow, nobody's going to lend to the government if there's no prospect of getting paid back. What that means is that the central bank has to prevent the interest rate from rising. And it does that by increasing the supply of money to accommodate the higher money demand. So what do we see happening? Well, now we go back to the money market, and whereas before we had nothing changing, now what we have is, in order to keep the interest rate from rising, the government, the central bank, is going to have to supply more money. And as the central bank supplies more money, demanders are going to slide up this demand curve, and they're going to have to supply exactly enough money so that the price level in the money market is the same as the price level in the bond market. If there's no change in income, which there isn't by assumption because it's exogenous, and we have that the nominal interest rate is constant, then this real demand for money is unchanged. So therefore, the money supply is going to have to rise by enough so that the real supply of money is the same under this new price level. So this is a nice example where the effects of fiscal policy depend on monetary policy behavior.